Financial technology, or fintech, is reshaping how the world handles money. From mobile money in Africa to cutting-edge blockchain in Asia, fintech is breaking barriers, driving financial inclusion, and revolutionizing economies. Today, we'll explore fintech's global impact, the role of economic policies, and the vast opportunities in emerging markets. Let's dive in. Section 1. Global Fintech Innovations. Let's start with how fintech innovations are shaping continents in unique ways. In Africa, fintech is a game changer for financial inclusion. Take mobile money platforms like M-Pesa in Kenya and MTN Mobile Money in Ghana. These services allow users to transfer money, pay bills, and even access loans using their phones. No bank account needed. This innovation brings financial services to millions, especially in remote areas. Asia is leading in advanced technologies like blockchain and AI. Countries like China and Singapore are trailblazers. In China, platforms like Alipay and WeChat Pay handle billions of transactions daily using QR codes and NFC technology. Meanwhile, Singapore's Smart Nation initiative integrates digital financial services into daily life, setting a global example. Europe emphasizes regulation and innovation. The Revised Payment Services Directive, or PSD2, requires banks to share customer data with third-party providers. This has led to innovative digital banks like Revolut and N26, which offer features like cryptocurrency trading and seamless international transfers. North America, particularly the US, focuses on disruption. Companies like Square and Stripe revolutionize payments, while Robinhood and Acorns make investing accessible by eliminating barriers like high fees. In South America, fintech addresses local challenges like currency instability. Brazil's Nubank offers no-fee credit cards and digital accounts, serving millions who traditional banks often overlook. Despite regional differences, there's a shared drive toward inclusivity, efficiency, and security. Fintech is truly a global force, transforming how we interact with money. Section 2. Economic policies shaping fintech. Next, let's discuss how global economic policies influence fintech growth. Supportive regulations can be a catalyst. For example, Europe's PSD2 has spurred innovation by allowing third-party providers access to banking data. On the flip side, overly stringent regulations can stifle growth as compliance costs deter startups. Striking a balance between innovation and consumer protection is critical. Government initiatives also play a vital role. In Singapore, programs like grants and tech labs support fintech startups, fostering a thriving ecosystem. Similarly, countries encouraging foreign investments, like many in Asia-Pacific, see exponential fintech growth driven by venture capital. Macroeconomic factors like currency stability and inflation are equally impactful. In regions with volatile currencies, fintech solutions like cryptocurrency platforms offer alternatives, providing financial stability to users. As fintech evolves, economic policies must keep pace to support innovation while safeguarding consumers. The right policies can fuel growth, ensuring a balance between technological progress and financial stability. Section 3. Fintech in emerging markets. Emerging markets offer unparalleled opportunities for fintech. With growing economies and large unbanked populations, these regions are ripe for innovation. A prime example is mobile money. Platforms like M-Pesa in Kenya started as simple money transfer services, but now offer savings, loans, and insurance. This has transformed economies, giving millions access to the formal financial system. Credit provision is another area of impact. In places where traditional banks hesitate to lend, fintech uses alternative data, like utility payment history, to assess creditworthiness. This innovation enables microloans for individuals and small businesses, driving economic growth. Small and medium-sized businesses, or SMEs, also benefit. Fintech tools like digital bookkeeping and automated invoicing help SMEs manage their finances efficiently, contributing to broader economic development. Section 3. International regulatory environments and their impact. This industry faces some of the strictest regulatory challenges. Take the European Union's General Data Protection Regulation, or GDPR, as an example. It sets a global benchmark for data privacy, requiring companies worldwide to implement robust data handling measures when dealing with EU residents' data. Non-compliance can result in steep fines and reputational damage. Similarly, in the US, the Sarbanes-Oxley Act demands strict financial reporting standards. Even non-US companies operating in or trading with the US must adhere to these guidelines, ensuring transparency and accuracy in corporate governance. Environmental regulations also impact operations. For instance, the European Union's emissions trading system compels companies to cap carbon emissions and invest in sustainable technologies. While challenging, such measures encourage innovation and leadership in sustainability. Also, talk about trade regulations. With policies like Brexit or shifting US trade strategies, businesses must continuously adapt to changing tariffs and customs duties. The key to success? Agility and proactive planning. Section 4. The importance of international collaboration on fintech standards. These standards help businesses navigate the often complex and diverse regulatory landscapes that can differ from one country to another. Without international collaboration, fintech companies aiming to expand globally would face high costs and significant delays, struggling to meet varying regulatory requirements in every country they operate. Key international bodies driving collaboration. Now, who is leading the charge on these international standards? Several formal international bodies play a key role in this collaboration, such as the Financial Stability Board, FSB, and the International Organization of Securities Commissions, IOSCO. These organizations bring together regulatory authorities from around the globe to discuss and develop international standards that apply to fintech and the broader financial sector. By engaging with these bodies, countries ensure that their own regulatory frameworks remain competitive on a global scale while still being locally relevant. Global payment systems and blockchain. Another key area of international collaboration is the development of global payment systems. Innovations like blockchain and cryptocurrencies have the potential to redefine cross-border transactions. By creating these global standards, countries can help reduce the complexity of cross-border transactions, which in turn encourages more inclusive economic growth. When payment systems work seamlessly across borders, financial inclusion becomes more accessible to underserved populations, allowing them to participate in the global economy. Challenges in achieving global consensus. Of course, collaboration isn't without its challenges. Different countries have different priorities, economic policies, and levels of technological advancement. These disparities can make it difficult to reach a consensus. Additionally, fintech is seen as a highly strategic sector for many countries, and national interests often come into play when it comes to setting regulations. One challenge is ensuring that these international discussions include diverse perspectives. Emerging markets, where fintech can have a profound impact on financial inclusion, must have a voice in developing global standards. It's crucial that the collaboration doesn't just favor the economically dominant countries, but reflects the needs and priorities of all nations. The need for openness and flexibility. For collaboration to truly work, it requires openness, mutual understanding, and flexibility from all parties involved. Regular dialogues, shared projects, and innovative regulatory trials, such as regulatory sandboxes, help foster a more harmonized approach to fintech. These sandboxes allow fintech companies to test new products in a controlled environment, ensuring that regulators understand the technology while giving startups the freedom to innovate. Section 5. The role of international fintech hubs. Now let's shift focus to the role of international fintech hubs. These hubs have emerged as powerful epicenters for innovation, driving significant technological advances in the financial services industry. From Silicon Valley to London, Singapore, and beyond, these hubs are far more than just geographical locations. They are vibrant ecosystems where ideas, capital, and talent converge to push the boundaries of financial technology. The power of innovation and entrepreneurship. One of the defining characteristics of these fintech hubs is their ability to foster innovation. Startups, venture capitalists, established financial institutions, and regulators all work together in these hubs, creating an environment where rapid iteration and collaboration can take place. In Silicon Valley, for example, the mix of tech expertise and venture capital has birthed some of the most pioneering fintech companies, leading the way in mobile payments, personal finance, and cryptocurrency. These programs provide seed funding, mentoring, office space, and most importantly, networking opportunities for emerging companies to grow and scale in the competitive financial landscape. Bridges to regulatory insight. Regulatory insight is another major benefit of fintech hubs. These hubs are often located in regions with proactive regulatory environments. For example, London's Financial Conduct Authority, FCA, has pioneered regulatory sandboxes, allowing startups to test new financial products in a real-world environment without immediately incurring the usual regulatory consequences. This approach helps fintech companies refine their products while giving regulators a better understanding of new technologies. The result is a more adaptive and forward-thinking regulatory framework that helps both startups and the broader financial ecosystem grow in tandem. Attracting global talent. One of the unique aspects of fintech hubs is their ability to attract talent from around the world. These hubs pull in professionals with expertise in technology, finance, and business from all corners of the globe. This diversity fuels innovation, allowing companies to develop creative solutions that cater to different markets and regulatory systems. Facilitating international collaboration. Fintech hubs also act as nodes in a global network, facilitating cross-border collaboration. Many of these hubs host international summits and conferences that bring together thought leaders, regulators, and entrepreneurs from around the world. These events foster the exchange of ideas and help stakeholders align their efforts to tackle shared challenges, from cybersecurity threats to financial inclusion. Impact on local and global economies. Finally, the influence of fintech hubs extends beyond innovation. On a local level, they stimulate economic growth by attracting investments and creating high-value jobs. On a global scale, they contribute to economic diversification and stability, providing resilient financial systems that can weather traditional economic downturns. Additionally, innovations born in these hubs, like mobile money, can have a profound impact on developing economies, where traditional banking infrastructure is limited. Conclusion. In conclusion, international collaboration on fintech standards and the role of fintech hubs are essential to the future of global finance. These collaborations drive innovation, enhance security, and promote financial inclusion, making financial services more accessible, efficient, and secure worldwide.